When you're buying a home and shopping for a mortgage, of course, you want to get the lowest possible interest rate. So I'm going to show you exactly how to do that when looking for the right lender. So we're going to talk about permanent rate buydowns, temporary rate buydowns, HomeReady and HomePossible mortgages, a credit audit, loan terms, shopping around, of course, and a bonus, how to get the seller to pay for your low interest rate. So let's talk about permanent rate buydowns. Now, you might know this more as paying discount points for a lower than market interest rate. So a permanent rate buydown is when you pay money up front or at the time of closing to get a lower rate than what you might actually qualify for. That's paying discount points. And one discount point is equal to 1% of whatever you're borrowing. So if you're borrowing $300,000, you pay one discount point. That means one discount point is equal to $3,000. Now, I'm going to not to get too detailed into discount points. If you want to learn more about them, please watch my video that talks specifically about discount points and subscribe. But I'm going to show you how to use that permanent rate buydown to buy a lower rate. So what these are used for is to reduce the monthly payment, of course, and make the home more affordable. Now, depending on the market, it may or may not make sense to pay any discount points to get a permanent rate buydown. But there are cases, even if the market doesn't dictate it being the right move, where you need to do it. There are some cases where a borrower like yourself might have too high of a debt to income ratio, meaning that the amount of money you make monthly is not quite high enough to qualify for the price property you're looking at. And a way to qualify might be to buy a lower than market interest rate, which would be done with a permanent rate buydown or paying discount points. So in that situation, it would be a necessity, where in other situations, it's really a novelty. Just be able to say you have a lower interest rate and a lower payment, where maybe you plan to refinance in the near future and you'll never really see the true benefit of buying that rate down permanently. So that's important to understand. And that's something you want to talk to your lender about, because if it's needed to qualify, it makes sense. If it's not needed to qualify, it may not make sense at all for you to go ahead and do that. Now, something that is popular in a higher interest rate environment that can benefit more or less anyone who's buying a property is a temporary interest rate buydown. Now, these have become more popular when interest rates increase significantly over a short period of time, because it was a lot for people to pallet. Right? They went from seeing rates in the 2s and 3s to rates in the 6s and 7s. And that's a lot to digest for someone who's trying to buy a property. And combine that with higher property values and prices, and it makes homes almost seem unaffordable for the average consumer. So what we see a lot of for buyers like yourself is we actually see sellers giving credits to the buyer to use for temporary rate buydown. So unlike a permanent rate buydown, the name temporary should tell you everything you need to know. It's not for the entire life of the loan. It's for a set period of time. It could be a 1-year period, a 2-year period, or a 3-year period. But during that period of time, the rate is actually reduced. So as an example, a 1-year temporary rate buydown would have a lower interest rate by 1% for the first year. So if you qualified for a 7.5% interest rate, instead of 7.5 for the first year, you'd be at 6.5. So that's just the general rule of how that works. But it keeps the rate lower and the payment lower for the early year to 3 years of the mortgage. Now, the types of temporary rate buydowns and how they work is pretty easy to explain and pretty easy to understand when you see it pictured out. So a 3-2-1 buydown, right? A 3-2-1 buydown is a 3-year temporary buydown. The 3 represents the first year and the rate being reduced by 3% that first year. The 2 represents the second year and the rate being reduced by 2% the second year. And the 1 represents the third year and the rate being reduced by 1% for the third year. So as an example, if your rate is 7.5%, that's the rate you qualify for based on where the market is today. Your first year, that rate would be 4.5, 3% lower. The second year, that rate would be 5.5, which is 2% lower. The third year, that rate would be 6.5%, which is 1% lower. And then from year 4 through 30, assuming you still had the same mortgage, you didn't refinance, you would be at the 7.5% rate, which was the market rate that you qualified for at the time you got the loan. 2-1 buy down works the same way, but rather than 3 years, it's 2 years. So it's 2% lower the first year, 1% lower the second year. A 1-0 buy down, which I already mentioned, is lower for the first year by 1%. Now, here's a pretty cool thing about temporary buy downs, besides the fact that they reduce your payment and your interest rate substantially for the initial period of time. The money to buy for these buy downs would technically come from the seller 99% of the time. The amount you receive toward the buy down is equal to your savings over that period of time. So your lender needs to work with your realtor to let them know how much of a credit the seller would need to give you to cover the buy down, whether it's a 3-year, a 2-year, or a 1-year. But that money's actually held in an account by your lender. It's essentially an escrow account, and it's applied toward your mortgage payment every month. What happens is, if you refinance sometime within the buy down period, let's just say you did a 3-year buy down, and rates drop and you want to refinance halfway through the 3 years. So you're 18 months into this buy down period. Any money that's still in that account with the lender from the buy down credit belongs to you. So when you refinance, the lender gives you that money back and it can be used toward your closing costs on the refinance. Or it can even be used to buy down the balance on your mortgage, therefore reducing what you owe on the home. So the money's not lost is the point. The permanent rate buy down that I mentioned first, with the discount points, anything you pay to permanently buy your rate down at the time of closing, that money is gone once you close. So if you refinance the same 18 months later, like we're talking about with this type of scenario with a temporary rate buy down, you're gonna be out that money. So you may never have actually benefited financially over that period of time based on your savings when comparing it to the cost. So that's another neat thing about temporary rate buy downs, is the money is yours, whether it's used for the buy down over the full term, or it's used toward closing costs if you're to refinance sooner than the end of the temporary rate buy down period. Now, HomeReady and HomePossible mortgages. So these are 2 mortgage programs offered by Fannie Mae and Freddie Mac, where they're help buyers who have income at or below 80% of the area median income where they're looking to purchase a home. Now, we can show you where to look this up, and actually in some of my other videos, I've already showed you how to look up the area median income for different areas throughout the United States, so please subscribe to see that video. But if your income is at 80% or below of the area median income, then you can actually qualify for lower interest rates, a lower down payment, and lower mortgage insurance, assuming you're putting less than 20% down. With HomeReady and HomePossible mortgages, the rate is the same whether you have the minimum 620 credit score, which is the minimum for a conventional mortgage, or 800 plus credit, which would be top tier. And it's because any adjustments that would typically be made to the interest rate for credit score or down payment or property type, we call these loan level price adjusters as lenders, those are all removed when you're using these 2 programs. And that result is a lower interest rate than what you would qualify for if you were doing a regular conventional mortgage. So make sure to ask your lender about HomeReady and HomePossible if you've checked to see if your income falls within the 80% of the area median income where you're looking to purchase. And to be clear on that, your household income might be above the 80%, but the income that's used to qualify for the mortgage itself is what needs to be 80% or less. It's not that your household income needs to be 80%. So your household may make more income than the 80%, but as long as the qualifying income is 80% or less, then you would be eligible for this program. And what's also cool about it is normally to put 3% down with a conventional mortgage, you need to be a first-time home buyer, meaning you have not owned a home in the last 3 years. But with this program, you can put 3% down even if you're not a first-time home buyer. It just has to be used for the purchase of a primary residence, meaning a home that you plan to live in year-round. Now, let's talk about credit. Credit is extremely important, as we know. It's one of the key factors in qualifying for a mortgage, right? Credit, income, employment, assets. So let's look at the credit piece. Let's just say that you want to qualify for a mortgage, but you're not quite ready to buy a home. Well, it's a good idea to still speak with a lender far enough in advance where they can pull your credit for you and perform a credit audit. This is where they're going to review everything on your credit report with you and give you some pointers on things that can be done to potentially improve your credit prior to trying to qualify for a mortgage. You don't want to go and have your credit pulled right when you find a home, because there might be things you need to work on that are unexpected. You want to give yourself enough time, right, a long enough runway to work yourself up to the time to buy a property so that you can take care of those items. And a credit audit is just that. So the lender's going to review your credit report. They're going to check it for accuracy, identify any discrepancies. There are times that things report to credit that are incorrect, right? The creditors aren't always accurate, and the information on your credit report's only as good as what they report. So if there's something incorrect, you want to be able to address that and have it resolved. You want to create a plan for improving your credit, whether that's working on budgeting and paying down some credit cards, right? Or maybe you have to get a new credit card in order to build some credit. It works in both directions. And then you want to monitor any changes. Maybe you want to put yourself on Credit Karma or a site such as that, where you can see the accurate information on your credit report in real time. The scores might not match, but at least you can see what's on the report and you can keep an eye on what's going on. But it's important to keep an eye on your credit anytime you're looking to purchase a property and qualify for a mortgage. Loan terms. Now, loan terms are essentially the length of the loan that you're obtaining. So these can vary. I think naturally buyers will think they have to get a 30-year mortgage. That's the most common type of mortgage. As a matter of fact, the most common are 15, 20, and 30. Because that's what most banks and lenders offer. However, there are custom loan terms. I know we offer custom loan terms that are built around our clients, our borrowers. Maybe you want a 29-year mortgage or you want a 18-year mortgage, right? So we can work custom loan terms anywhere from 8 years to the 30 years. So you have to work around what your plans are. It's whatever. If your goal is to pay the home off faster and you don't want a 30-year mortgage for whatever reason, you want to know you have a 25-year mortgage or 26-year mortgage, whatever you see fit, that can be done. I think it's important to know that you're not bound to the traditional 15, 20, or 30-year terms. An alternative to those fixed terms, right, the 15, 20, and 30, that's a fixed term where the interest rate will not change from year one all the way through whatever the length of that term might have been, would be an adjustable rate mortgage. Now, adjustable rate mortgages are still 30-year mortgages. The difference is the interest rate on adjustable rate mortgages is not fixed for all 30 years. It's fixed for a shorter period of time within that 30-year mortgage. And the reason someone would take an adjustable rate mortgage over a traditional fixed rate mortgage is they potentially plan to pay the home off faster, whether it's just paying it off and keeping the home or it's paying it off in the form of selling. Maybe you're someone who moves a lot for work. You get relocated often. A 30-year fixed rate mortgage may not be the right option for you. An adjustable rate mortgage may make more sense if you can get a rate that's fixed for a long enough period of time that you're going to stay in the property, and if it has a lower interest rate than the fixed rate counterpart, right? That's the biggest piece. There's no reason to take an adjustable rate mortgage if the rate is the same or higher than the fixed rate. The reason you would go with an adjustable rate mortgage is because in most cases, an adjustable rate mortgage has a lower interest rate than a fixed rate mortgage. So the most common types of adjustable rate mortgages are a 5-1, 7-1, and 10-1 arm. The first number in each of those arms represents the fixed period. So a 5-1 arm is fixed for 5 years. A 7-1 arm is fixed for 7 years. A 10-1 arm is fixed for 10 years. The second number, the 1, in this case, represents how often the rate would adjust after the fixed period. So that means it would adjust once per year after the fixed period. So if you had a 5-year arm, after the 5th year, the rate would adjust, and then it wouldn't adjust again until a year later. So it's not something they offer adjustable rate mortgages that could adjust monthly, but more common than those are going to be annual adjustable rates or every 6 months. But as I said, the most important thing to take when it comes to adjustable rate mortgages over fixed rate is that you're only taking that adjustable rate mortgage if it fits within the time period you plan to keep the home. And of course, the rate is lower than what you can obtain on a fixed rate mortgage. Now, shopping around. Now, you definitely want to shop around because you want to empower yourself, right? You want to know that you've looked at all your options. You want to know that you're actually getting the best possible terms, whether it's the rate and the cost or just the lender you're working with is the one you're comfortable with. But you want to know that you've done your shopping in order to make that decision and that you didn't just go with the first person you spoke to. And what's crazy is that 75% of buyers don't actually shop, and that's according to the CFPB, right? So, by not shopping, I'm saying they don't apply with more than one lender. 1 out of 4 buyers apply with a mortgage with more than one lender. 3 out of 4 don't even apply for a mortgage with anyone other than the first lender that they speak to. They might shop around for interest rates, right? Roughly 50% of home buyers shop around for interest rates, but that's not truly shopping for a mortgage. You can go online and look at an interest rate on some sort of website. That doesn't mean you shopped. Shopping truly means you spoke to a lender, you made loan application with that lender, they've gone through the process. That's truly shopping. And the fact that 1 out of 4 people do that is absolutely crazy to me, because how do you know that you're getting the best possible option for yourself and your home buying goals? So, shopping around allows you to do an interest rate comparison, closing cost comparison, check the different loan terms and check the different loan programs, because some lenders have access to programs that others don't. So you don't want to leave something on the table that might be available to you just because you only applied with one lender. You have a window of time to shop and speak with multiple lenders with credit pulls where your credit score will not be impacted negatively. It's the right to shop, and you can check it out on the CFPB's website. You have a 45-day window to shop specifically for mortgages where the subsequent inquiries after the first do not impact the score. That's something that a lot of people are nervous about, and that's understandable. And so you have that window of time. Make sure you utilize it, because that is your time to shop. Now, here's a bonus for you. We talked about getting lower rates by permanent rate buydowns, temporary rate buydowns. I talked about temporary rate buydowns coming in the form of a seller credit. Well, that's how you're going to go ahead and get a lower interest rate utilizing the seller's funds, right? Use the seller and get seller concessions to get a lower interest rate. Right now, there's less competition in the market when you're buying a home. A lot of people still haven't gotten back in because they feel rates are high or they feel home prices are high, which means that you have more leeway when it comes to negotiating terms with the seller. But rather than trying to negotiate the price of the property down, you can get more bang for your buck by negotiating a seller credit to go toward buying your lower interest rate. Preferably, I would say buying the lower rate using a temporary rate buy down, because that's going to save you the most money in the short term, because at some point in the near future, rates will come back down, you're going to refinance, and you're going to get a lower rate. So what you want to do now is you want to use a seller credit, have your realtor negotiate that, and utilize it to buy the lower interest rate, which in turn saves you money monthly, which is going to make the home more affordable to you regardless of the market that we're currently in. If you found this information helpful, please comment below. I reply to each and every one of them. And subscribe for more videos like this one.